Breaking news confirms what we've been tracking for months. The United States Mint has officially suspended online sales of silver numismatic products. At the same time, the Royal Canadian Mint, one of the most advanced minting operations in the world, reports that its flagship silver maple leaf coins are sold out across major distributor networks. Two sovereign government mints, two of the largest economies in the Western Hemisphere, both unable to supply physical silver to their own citizens simultaneously. This is not speculation. This is not a rumor. This is verified information, directly from official government sources, acknowledging they cannot meet physical silver demand at current market prices. Before diving into the data, let's be clear, I will never ask for your money. No paid signals, no mentorships, no courses, no investment schemes, no subscriptions, no premium content behind paywalls. If anyone using my name attempts to sell you anything, report it immediately. That is a scam. I create this content because verified information matters in financial education. This is education, not financial advice. Protect your capital. Independently verify every claim I make through primary sources. Avoid anyone promising easy money in this market. Those promises always come from people who want to take your money, not help you grow it. Now let's examine the implications of these mint suspensions. They are far more serious than most people realize. The U.S. Mint claims extreme market volatility forced them to halt online operations to recalculate their silver product pricing. But when you read between the lines, the truth is clear. The United States Mint cannot source raw silver at prices that allow profitable production of American silver eagles. Every coin sold at current spot prices would generate a loss. Think about that. The sovereign mint of the world's reserve currency issuer, the most powerful economy on Earth, is admitting it cannot profitably produce silver coins at today's market rates. Analysts call this a force majeure event in the retail silver market. These are circumstances beyond normal operational control, preventing contract fulfillment. This is not a temporary supply chain hiccup. Major U.S. dealers, including AppMax, JM Bullion, SD Bullion, and others, are now listing pre-sale dates for 2026 American Silver Eagles, with deliveries weeks or even months away. The premium to acquire actual metal has diverged completely from the spot price displayed on trading screens. We now live in a two-tier market, one price on the screen, a completely different price in the real world. Here are numbers verifiable today. International silver spot trades between $73 and $76 per ounce, depending on the market and contract month. Western spot sits around 73.50 on COMEX futures. Shanghai physical silver trades at $120, $130 per ounce. That's roughly a $50 premium, 50-60% higher than New York pricing for identical metal. The only difference is geography and Eastern buyers' willingness to pay the real market clearing price. The displayed price on trading screens is increasingly fictional. The real price is what you pay to take delivery of physical metal. That's the price that matters when demand spikes and supply runs low. The Royal Canadian Mint's stockout confirms this is not just a U.S. problem. The RCM is a global minting powerhouse, supplying bullion dealers across North America, Europe, and Asia. Their 1 Oz silver maple leaf, a trusted coin worldwide, is sold out both on the official portal and through major distributors. This isn't a temporary spike. Silver in Canada hit a record $129.82 CAD per ounce before this shortage. A pullback in price has done nothing to restore inventory. Weak hands have sold, leaving only holders who view silver as insurance, not speculation. Registered COMEX silver is where the numbers become undeniable. Registered silver inventory has fallen below 100 million ounces. Current stock is about 98.1 million ounces. Open interest for March 2026 contracts is 429 million ounces of paper claims against that inventory. That's a coverage ratio of roughly 4.41, 4 paper claims for every physical ounce in the vaults. The situation worsens with withdrawals. About 785,000 ounces leave COMEX vaults daily. By first notice day on February 27th, registered inventory could drop to 85 million ounces or lower. First notice day is when holders of futures must declare if they want cash settlement or physical delivery. If even 25% demand physical silver, COMEX cannot fulfill requests. This is basic arithmetic, publicly verifiable. History tells us what happens if an exchange cannot deliver physical silver. Contracts are settled in cash at whatever price the exchange deems fair. Paper prices and physical prices formally diverge. That is happening right now. While the physical shortage grows in Western vaults, major bullion banks are shifting. JP Morgan, which held the world's largest short silver position for over a decade, is now long, holding 750 million ounces of physical silver. That single institution's holdings are roughly 7.5 times COMEX registered inventory. Exchanges have hiked margins to about 15%, requiring $25,000 per contract. This triggers liquidations of retail traders, allowing institutions to absorb positions at lower prices. The mechanics are documented and transparent in filings. The U.S. government also launched Project Vault on February 2, 2026, a $12 billion initiative securing 60 critical minerals for national security and industrial use. Silver is included. The federal government is now competing with retail buyers, investors, and industrial consumers for physical supply. This is not a short-term play. It permanently shifts market dynamics. Industrial demand further compounds this. Solar photovoltaics now consume 29% of annual silver industrial demand, nearly tripling since 2014. EU targets 700 GWh of solar by 2030, requiring hundreds of millions of additional ounces. TOPCon and 8JT solar cells use more silver per panel than previous generations. Manufacturers cannot substitute cheaper metals without sacrificing efficiency. They are price inelastic buyers. They will pay whatever the market demands. AI infrastructure is another demand driver. Data centers require silver for connectors, switches, thermal management, and servers. Tech giants like Microsoft and NVIDIA are building small modular nuclear reactors for data centers. Each reactor requires 156,000 ounces of silver in control rods using silver indium cadmium alloys. There is no substitute for these components. These companies will pay $200, $300 per ounce if needed, trivial compared to their cash reserves and trillion-dollar AI investments. The Shanghai Futures Exchange confirms market stress. Starting late February, participants without hedging quotas receive zero-lot delivery allocation for silver contracts. Zero, not reduced. SHFE also suspended account clusters for coordinated short selling that artificially suppressed prices. Multiple exchanges enforcing delivery restrictions simultaneously is a clear sign that the paper pricing mechanism is under pressure. Now let's examine the bearish case with full transparency, because understanding both sides is critical for anyone monitoring the silver market today. The nomination of Kevin Warsh as Federal Reserve Chair has triggered a major repricing of interest rate expectations across all asset classes. Warsh is widely regarded as a hard money hawk, consistently critical of quantitative easing and easy monetary policy. Markets interpreted his appointment as a signal that the new administration may tolerate short-term economic pain and asset price deflation to tackle persistent inflation. Following this news, real yields spiked, making non-yielding assets like silver and gold comparatively less attractive. The strengthening dollar further pressures commodities priced in dollars. International buyers now must exchange more of their local currency to acquire dollar-denominated assets. Today, February 18, 2026, the release of Federal Open Market Committee minutes could confirm continued hawkish sentiment. If the committee indicates rates will remain near 3.75% through April with no immediate cuts, algorithmic trading systems may respond by selling silver. This is a legitimate short-term risk that could push paper prices toward technical support levels near 72.80, potentially dipping lower toward 68.80 if selling accelerates. However, and this is crucial, the bearish scenario relies entirely on one assumption, that paper markets continue to dominate physical price discovery indefinitely. This assumption is being challenged by the events we've already discussed. The mint suspensions, vault depletions, delivery restrictions, Shanghai premiums, and government stockpiling all point to a growing disconnect between paper and physical prices. The arithmetic simply does not reconcile. The U.S. government cannot pursue Project Vault and stockpile silver, while paper prices remain at suppressed levels. Industrial users cannot build solar plants, data centers, or defense applications without securing physical supply, regardless of what screens say. Mining companies cannot simply produce more silver, because roughly 70% of global silver production is a byproduct of copper, lead, or zinc mining. You don't get more silver unless base metal production increases, which is dictated by base metal economics, not silver spot prices. We are witnessing a structural default in the Western pricing mechanism for silver in real time. Paper markets print one number on screens, while physical transactions demand a completely different price. The 50-plus Shanghai premium is proof that Eastern buyers will pay well above Western spot prices to secure actual delivery. This is not a temporary anomaly. It's a persistent arbitrage gap that confirms the market is malfunctioning relative to its official rules. Over the next 9 days, pay attention to several critical data points. COMEX registered silver inventory should be monitored daily. These reports are publicly accessible and independently verifiable. Track March contract open interest as first notice day approaches on February 27th. Observe whether holders roll forward to later delivery months or demand physical delivery. Follow the Shanghai premium daily to watch the divergence between Eastern and Western pricing. Any additional mint suspension announcements from global mints, Perth Mint in Australia, Austrian Mint, Mexican Casadmina, or South African Mint, will confirm the shortage is truly global. Every piece of data presented here comes from official primary sources. COMEX warehouse reports are publicly dated and accessible. Exchange policy changes are documented in filings and press releases. Mint suspension announcements are issued directly by government agencies. Shanghai pricing is reported daily on multiple financial platforms. Do not take anyone's word for this. Verify reports yourself. Cross-reference all claims with official documentation. Market participants who conduct this verification understand why 9 days matter, why a 4.4 to 1 coverage ratio is critical, and why 2 major sovereign mints simultaneously failing to supply silver to retail buyers is alarming. Those who wait for mainstream media to explain this in comfortable, digestible terms will be behind the curve. Months from now, retail buyers may scramble to acquire physical silver at sharply higher prices, wondering why no one warned them when the data was already in plain sight. The warning is documented. The information is public. Primary sources are accessible. The question is whether you verify independently or ignore inconvenient facts that challenge assumptions. Meanwhile, industrial demand continues to grow exponentially. Solar photovoltaic installations alone consume nearly a third of global silver industrial demand each year. This consumption has almost tripled since 2014 and is accelerating. Europe, North America, and Asia are all pushing aggressively towards solar capacity targets, with the EU aiming for 700 gigawatts by 2030. Meeting those targets requires hundreds of millions of ounces of additional silver, far more than currently available. New solar technologies, TOPCon and HAT panels, require higher silver content per panel compared to previous generations. Efficiency and durability cannot be compromised, so these buyers will pay whatever the market demands. AI infrastructure is another emerging driver. Modern data centers rely heavily on silver for connectors, switches, thermal management, and server components. Companies like Microsoft and NVIDIA are actively building small modular nuclear reactors to power data centers independently. Each reactor requires roughly 56,000 ounces of silver in control rods using silver-indium-cadmium alloys, critical for neutron absorption and preventing meltdowns. There is no alternative material that provides equivalent performance. These tech giants with trillions in cash can absorb silver costs easily. Paying $200, $300 per ounce is negligible compared to the value of securing uninterrupted AI operations. Globally, exchanges are acknowledging physical shortages in real time. The Shanghai Futures Exchange recently announced zero delivery allocation for participants without hedging quotas starting late February. That's zero, not reduced. They also suspended coordinated short-selling accounts attempting to artificially suppress prices. When multiple major exchanges implement delivery restrictions and investigate price manipulation simultaneously, it's a coordinated signal that paper pricing is under stress. The takeaway is that Western paper markets are increasingly divorced from physical reality. Registered COMEX inventory continues to decline, premiums in Asia remain elevated, sovereign governments are stockpiling, and industrial demand is surging. The disconnect between paper and physical prices is not theoretical. It is mathematically demonstrable and observable. Retail participants and institutional investors alike must understand the structural implications. Even if paper prices temporarily drop due to short-term policy or rate expectations, the physical market continues to tighten. First Notice Day, government stockpiling, industrial consumption, and Eastern premium divergence all indicate that real-world silver scarcity is accelerating. This is the landscape as we approach the last 9 days before February 27th. The numbers are verifiable, the trends are documented, the structural shortage is global, and the consequences for anyone relying solely on paper markets without understanding physical supply are significant. If you are watching, track the following: COMEX registered silver inventory daily, March contract open interest, Shanghai premium, and any new mint suspension announcements. These signals collectively indicate how the real silver market is functioning under extreme stress. Those who fail to verify independently risk being blindsided by market realities that are obvious to those who study primary sources. The fundamental point remains: paper markets no longer reliably represent the cost or availability of actual silver. Industrial demand, government stockpiling, and Eastern premiums have created a bifurcated market, one where the real price is dictated by scarcity and willingness to pay, not by the figures flashing on a screen. This structural reality is immutable. It will affect both short-term trading dynamics and long-term market allocation decisions. Looking ahead, the key is to understand how structural shortages, government intervention, and industrial demand converge to reshape the silver market. The consequences are profound, not speculative. We've already seen sovereign mints struggle to supply their own populations. Registered COMEX inventory is dwindling. Paper claims vastly outnumber physical ounces. The $50 Shanghai premium demonstrates the willingness of Eastern buyers to pay real market-clearing prices. All of this points to a bifurcated market that no amount of paper trading or algorithmic hedging can reconcile. Industrial consumption is relentless. Solar panels, AI data centers, nuclear reactor control rods, and advanced electronics continue to draw silver out of the market at rates unmatched by current production. The United States government's Project Vault ensures that critical minerals, including silver, are being prioritized for national security and industrial infrastructure. Billions in taxpayer dollars are being deployed to secure supply chains before metal even reaches the open market. Private investors and smaller industrial users now compete for whatever remains. We must also recognize that mining supply is inherently constrained. Around 70% of global silver comes as a byproduct of copper, lead, or zinc mining. Production cannot simply be increased on demand. Even if spot prices spike, output is limited by the economics of base metals, not silver alone. This structural limitation means that industrial demand and government stockpiling will continue to absorb any newly mined silver, leaving very little for discretionary investors. The math is undeniable. COMEX vaults currently hold roughly 98.1 million ounces of registered silver, while open interest on the March 2026 contract stands at 429 million ounces. That is a 4.4 to 1 coverage ratio, 4 paper claims for every physical ounce. Withdrawals of 785,000 ounces per day further reduce inventory, potentially leaving as little as 85 million ounces by first notice day on February 27th. If even 20-25% of contract holders demand delivery, the system cannot fulfill obligations. This is not fear-mongering, it is verified arithmetic. The exchange will be forced to settle contracts in cash, creating an official divergence between paper and physical prices. Meanwhile, major institutions have already positioned themselves strategically. JP Morgan's reported physical holdings of 750 million ounces dwarf registered COMEX inventory by multiple times. Margin hikes, now at roughly 15%, have liquidated smaller players, funneling positions into institutional hands. This mechanism of wealth transfer is fully documented in exchange filings and is observable by anyone willing to investigate. The global picture confirms the systemic nature of this crisis. The Royal Canadian Mint's flagship silver maple leaf is sold out, despite record prices and massive production capacity. The Shanghai Futures Exchange is imposing zero allocation on participants without hedging quotas. Coordinated short-selling accounts have been suspended for manipulation attempts. Multiple sovereign mints, multiple global exchanges, and major industrial players all acknowledge that the paper price no longer reflects physical realities. For market participants, this is an essential distinction. Short-term price moves driven by FOMC minutes, rate expectations, or paper market sentiment may appear bearish, but the underlying physical market remains tight and accelerating toward scarcity. Industrial consumers will continue to absorb supply regardless of paper prices. Eastern buyers will continue to pay premiums. Government initiatives will secure large quantities of silver for strategic purposes. The divergence between screen prices and reality will persist and likely widen. Retail investors who fail to verify data independently risk being blindsided. Those who rely solely on paper prices may be left scrambling when physical demand spikes. First notice day is only 9 days away. Registered inventory could drop below 85 million ounces. 2 sovereign mints cannot supply their citizens. Industrial consumption continues to grow exponentially. Eastern premiums remain elevated. Government stockpiling is competing with private buyers. This is financial warfare in action. Understanding these dynamics requires monitoring 3 key indicators. First, daily COMEX registered inventory, public, verifiable, and updated every day. Second, March 2026 contract open interest, tracking whether holders roll forward or demand physical delivery. Third, the Shanghai premium to observe divergence between Eastern and Western pricing. Additionally, any announcements of mint suspensions worldwide will confirm the global nature of the shortage. Perth Mint, Austrian Mint, Mexican Casadmina, South African Mint, all must be watched. Industrial demand patterns are critical. Solar photovoltaic demand now accounts for nearly 30% of silver industrial usage, up sharply since 2014 and still rising. EU targets for solar capacity require hundreds of millions of ounces of additional silver, all of which is beyond current available supply. AI infrastructure and nuclear reactor development drive further demand. Control rods for modular nuclear reactors require high-purity silver alloys. AI data centers rely on silver for electrical and thermal management, where no substitutes are viable. The long-term picture is clear. Physical scarcity, strategic stockpiling, and industrial consumption are creating a structural disconnect between paper and physical silver markets. Spot prices on screens have become a fiction for practical purposes. Real prices are dictated by availability and the willingness of buyers to pay to secure delivery. Shanghai premiums of $50 or more are the clearest evidence that markets are bifurcated, with Western paper markets no longer representative of physical reality. Every participant should verify these facts independently. All data presented is publicly available through official sources. COMEX warehouse reports, exchange filings, mint announcements, and Shanghai Futures Exchange pricing are accessible and verifiable. Cross-reference claims against multiple primary sources to understand the true nature of the market. Those who do the homework understand the significance of 9 days until first notice day, 4.4 to 1 coverage ratios, and the implications of 2 major sovereign mints being unable to meet demand. The coming days are critical. Those who monitor inventory, contract obligations, Eastern premiums, and mint announcements will have the clearest picture of physical market stress. Those relying solely on paper market signals will be vulnerable to sudden shocks as demand outstrips supply. Ultimately, the lesson is clear. The silver market today is experiencing structural stress unseen in decades. Industrial demand, government stockpiling, and institutional accumulation are reshaping the landscape. Paper prices no longer provide accurate guidance. The bifurcation between Eastern physical prices and Western paper prices demonstrates that the real cost of silver is determined by scarcity and willingness to pay, not by screen quotes or short-term speculation. 9 days remain until February 27th, first notice day. Registered COMEX inventory may drop below 85 million ounces. Industrial demand continues to rise, governments are stockpiling, Eastern premiums remain high, and 2 sovereign mints cannot supply their citizens. The arithmetic is inescapable. Physical scarcity is real. Market participants who ignore this reality will face consequences. Those who verify, prepare, and understand the structural dynamics will be in a position to act decisively. This is financial education, not financial advice. Protect your capital. Verify every data point independently. Understand the structural realities of supply, demand, and global premiums. Recognize that paper markets no longer dictate the true price of silver. Industrial demand, government interventions, and Eastern market behavior now define reality. Every ounce of data here is public, verifiable, and actionable. COMEX reports, exchange filings, mint announcements, and Shanghai pricing data are all accessible. Verify them yourself. Understand the implications, plan accordingly. Physical scarcity is accelerating. Government stockpiling is real. Industrial demand is growing. Eastern buyers are paying premiums. The next 9 days are critical. First notice day will expose the full stress of the system. This concludes the analysis. The numbers are public. The shortages are real. The physical market is tightening. Paper markets are diverging. Governments, industrial consumers, and Eastern buyers are competing for the same limited supply. Verify, analyze, and protect your capital. Financial warfare is unfolding in plain sight, and the facts are available to anyone willing to look.